Case study: Balancing debt and ownership, the Hinduja Group's Reliance Capital acquisition. The Caseverse platform provides a strategic perspective on contemporary real-world business events by presenting them as engaging and insightful case studies. These cases serve as powerful learning resources and can be applied in various contexts, including personal knowledge enhancement, academic classroom discussions, corporate training programs, managerial development workshops, brainstorming and strategic planning sessions. The case studies on the Caseverse offer both conceptual depth and practical relevance, making them an invaluable tool for anyone seeking to understand and navigate the complexities of modern management. The cases are developed and shared with the purpose of helping the viewers develop critical thinking and analytical skills. Learning objectives: by working through this case, you should be able to analyze the relationship between capital structure and firm value in both idealized and real-world settings, evaluate the trade-offs between debt and equity financing in strategic acquisitions, identify real-world frictions, taxes, bankruptcy risk, investor perception that cause deviations from the pure Modigliani-Miller model, explain the Modigliani-Miller Proposition 1 and Proposition 2 in the context of a real corporate acquisition. Background: in May 2025, the financial sector in India witnessed one of its most notable acquisition moves. The Hinduja Group's investment arm, IndusInd International Holdings Limited (IIHL), completed the long-awaited purchase of Reliance Capital Limited, a once prominent non-banking financial company (NBFC), formerly controlled by Anil Ambani. Reliance Capital had been under insolvency proceedings for years, burdened by debt and liquidity challenges. The Hinduja Group saw an opportunity to acquire its diversified financial services portfolio, including insurance, asset management, and lending operations, at a price that promised strategic synergy with the group's existing banking footprint through IndusInd Bank. To finance the 9,661 crore rupees acquisition, IIHL planned a mix of equity contribution from group companies and a 4,300 crore rupees bond issuance, anchored by global financial giant Barclays. This capital structure decision became the heart of an internal strategic debate. The strategic dilemma: the Hinduja family's investment committee faced two major pathways to finance the deal: funding almost entirely through internal equity capital, using reserves from group entities and investor capital from trusted partners, blending equity with a significant dose of debt financing via long-term bonds placed in domestic and international markets. At first glance, debt appeared to be a riskier proposition. The financial services industry was still recovering from periods of high interest rates and fluctuating investor sentiment. However, debt also promised tax advantages and the ability to retain more ownership control without bringing in external equity partners. On the other hand, an equity-only approach was perceived as safer from a cash flow standpoint, but it risked diluting the returns for the group over time and could slow down capital deployment for other expansion projects. Discussions in the war room: the committee meetings grew intense. Argument for more equity: some members argued that avoiding large borrowings would protect IIHL's cash flows from future interest burdens, especially given the uncertain pace of Reliance Capital's turnaround. If the asset doesn't generate enough profit in the first 2 years, servicing heavy debt could put us under pressure, warned one senior advisor. Argument for blending with debt: others pointed out that the cost of debt, in this case, was lower than the potential cost of bringing in outside equity partners. Barclays was offering to anchor the bond issuance, which would enhance market confidence. We can preserve more ownership while also taking advantage of interest deductibility on the bonds, noted the CFO. The CFO also reminded the committee of a long-standing principle: in well-functioning markets, the value of the firm isn't solely determined by whether it's funded with more debt or more equity. Rather, it's driven by the performance of the underlying assets and the efficiency of operations. Our focus should be on improving Reliance Capital's profitability. not on overthinking whether debt or equity is the purer form of financing. Key financial data and developments. Total acquisition financials. Acquisition price. IIHL's resolution bid stood at approximately 9,650 crores rupees to 9,861 crores. Initial payment 2,750 crore rupees equity paid into escrow with a committee of creditors. Debt tranches. First tranche September 2024 3,000 crore rupees raised via NCDs at a high coupon arranged by Barclays and 361. Second tranche 4,300 crore rupees prepared for disbursement post-listing arranged by the same parties. Additional solvency infusion 200 crore rupees infused into Reliance General Insurance to shore up regulatory capital. Debt to equity composition. Debt funding totaling around 7,300 crore rupees, 3,000 crore rupees plus 4,300 crore rupees. Equity allocation 2,750 crore rupees plus 200 crore rupees. Solvency infusion around 2,950 crore rupees. Approximate debt equity ratio around 70% debt and around 30% equity, a heavier reliance on leverage than initially assumed. The bond structure. The 4,300 crore rupees bond issuance was structured with a medium-term maturity, appealing to both institutional and high-net-worth investors. Barclays' involvement helped secure competitive pricing and wide placement. The bond proceeds would be earmarked solely for the acquisition, ensuring clarity for investors and regulators. By choosing a balanced approach, roughly 45% debt and 55% equity, IIHL could retain majority control of the acquired business without relying heavily on new outside shareholders. Benefit from interest cost offsets against taxable profits in the future. Signal to the market that the Hinduja Group was confident enough to leverage the asset but cautious enough to keep debt within manageable limits. Post-acquisition strategy. IIHL's integration plan for Reliance Capital was built around three pillars. Stabilization, ensuring continuity in key operations like insurance underwriting, asset management, and lending to priority segments. Synergy realization, leveraging IndusInd Bank's infrastructure to cross-sell financial products and reduce duplication of back-office functions. Growth financing, using the blended capital structure to free up funds for targeted investments in digital lending and insurance tech platforms. The leadership team expected that within 3 years, improved operating cash flows would enable early repayment of a portion of the bond, further optimizing the financial structure. Market perception. The announcement of the financing mix was met with cautious optimism in the markets. Analysts praised the group for not over-leveraging in a sensitive sector while still using debt smartly to avoid excessive equity dilution. Credit rating agencies assigned the bond a stable outlook, citing the Hinduja Group's diversified business base and strong governance track record. Investors noted that the presence of Barclays as an anchor not only boosted confidence but also broadened the reach to global capital markets. Funding costs and market considerations. In May 2024, prospective lenders Standard Chartered, Barclays, 361 Prime, quoted coupon rates around 15% to 15.5%, reflecting elevated risk and asset collateral quality. IIHL attempted to negotiate a reduction of nearly 1% in the coupon rate, underscoring tension between cost of capital and market pricing, asset base and post-acquisition value creation. Assets under management, AUM. Reliance Capital managed assets worth more than 90,000 crore rupees across insurance and home finance. Conservative business valuation. Post-acquisition, IIHL estimated Reliance Capital's value at around 20,000 crore rupees. Profitability update. Reliance General Insurance posted net profits of 315 crore rupees in FY 2025, up 12.5%, signaling early turnaround success. Regulatory and timeline highlights. IRDAI concern. The insurance regulator flagged IIHL's acquisition structure for potentially breaching FDI limits and wanted details on borrowing structures and investor identity. Approval bottlenecks. DPIIT, Department for Promotion of Industry and Internal Trade, approval was necessary for the second debt tranche. Completion was expected by January 2025. Regulatory delay and delisting prerequisites influenced debt disbursement timing. Completion timeline, all procedures, including delisting and asset transfer, were projected to finalize by in January 2025. Strategic listing plans, IIHL aimed to list key insurance subsidiaries by 2026 to 2027, enabling early debt repayment and value crystallization. The learning moment. Internally, the Hinduja Group treated the financing decision as a learning experience in capital structure discipline. The discussions highlighted several enduring truths in corporate finance. Operational performance is the winner. Even the most sophisticated financing strategy fails if the acquired asset cannot deliver consistent cash flows. Debt has its place. Borrowing is not inherently dangerous if managed prudently and aligned with revenue growth plans. Ownership retention matters. By using debt instead of bringing in more equity partners, IIHL preserved its strategic autonomy over the long term. Markets respond to confidence. The choice to involve a credible global institution like Barclays reassured stakeholders about execution capability. About Dr. KBS Kumar. Dr. KBS Kumar is a distinguished author and teacher in the field of management, with an exceptional portfolio of over 100 published case studies spanning diverse domains of business and management. His work has been recognized on the global stage, having won more than 20 international awards in case writing. With extensive experience in training corporate leaders and guiding academic institutions in the art and science of case writing and case-based teaching, Dr. Kumar brings a rare blend of academic rigor and practical insight. Dr. Kumar actively mentors and coaches students, scholars, teachers, and practitioners across multiple management disciplines in case writing and case-based teaching and case-based learning. For more management case videos, subscribe to the channel. The Case Was. Mail thecasewars1@gmail.com. Contact 970-3368234.